Hi, hello. Today I want to do something different. I was just thinking, like the other day, that there's a lot of this content on YouTube where people are just recommending you stocks to buy. So I was thinking, like, let's stress them a little bit. So what I'm gonna do on the channel is we're gonna pick one of those individuals on the internet and then see what stocks they are buying, and then we're gonna have a look at the data from a value standpoint. So we're gonna look at the operating ratios and free cash flow ratios to try to like draw a baseline where a company should be. I have in front of me a data set which contains pretty much the entire stock market. I mean, not the entire stock market, because I took out the very, very tiny companies. So we're going to be everything that's above 1 billion, every single one in the US stock market. Okay. So we're going to pick this video, and then we will see if these stocks that are being recommended on the internet are actually a good investment or not. And hopefully by doing this exercise, we can, save some people from losing some money. Okay. Okay, this one looks interesting. Let's do this one. Mandatory to buy these two stocks. Okay. By Stealth Wealth Investing. The first thing that I'm gonna do is I already did a little bit of research. I already watched the video, but I want you to get a sense of the entire video, because I don't want to be critical of every single investor on the internet. Think of it more like a second opinion that I'm doing, a different perspective. So
mandatory to own stock, but the end results when you get these four.
Let's do a summary. Summarize. Okay, oh, that's misspelled there. So this is what he's talking about, yeah. The first part of the video, the first 7 minutes or so, are generic, is just describing the kind of stocks he's investing in and what he's looking after. So the first point we're gonna be execution from management. He's looking for growth, which is sensitive. Like, if you want to make money in the stock market, you need growth to some extent. Even if it's a solid business like Amazon, you still want the business to grow at least, I don't know, above the inflation level. Consistent superior performance and fortress financials. Nothing wrong up to this point. This is exactly what I would look into a stock if I was looking to find a company to put my money in. And he's recommending Palantir and SoFi. And let's have a look what he's saying. That would gonna be 706.
All these little different rules and all that sort of stuff makes the difference between prudent investors who are able to take advantage in lots of different sectors and ones that can't. Massive amounts of cash just sitting there ready to go, right? Plenty of free cash flow quarter in and quarter out, so you're not worried about ever being short in a cash position. No matter how ugly it gets out there, these companies can absolutely weather any storm that happens because their financials are like a fortress. So let's go through the two companies I feel meet this criteria for me and are must-owns in my opinion for me, of course. Now, comment down below with the two companies you feel are a must-own for you. You know, your situation, your plan, your risk tolerance, and all that good stuff. Let me know what are the two companies for you, but let's get to the two companies for me. And the first one up is Palantir. All right, so let's start right there with the first point. Incredible execution from management, and I think none of us would argue that you have had unbelievable execution from this management team for almost 3 years now, and they keep topping themselves. This last earnings was just ridiculous. It was other people call it video game numbers. Like, I gotta kind of agree, right? It's kind of like, whenever you're playing those old Madden games and such, and you'd run for 400 yards every single game. That's what I mean by video game numbers. Like, it just doesn't make any sense. It seems like it's right out of a video game. That is unbelievable high level execution from a management team. It doesn't get any better than that. I can't think of performances that have been better than they've given us over the past year. So to absolutely check this box, no doubt in my mind. Now, the next one is a massive runway for growth. And I don't think anybody here doesn't see a massive runway for Palantir in the AI space, right? AI is the future. They are absolutely one of the leaders along with NVIDIA. And I mean, leaders in terms of monetization, drawing money to the bottom line right now. I think a lot of big tech will catch up. And catching up doesn't mean they're taking away anything from Palantir. It just means they're going to start making a lot of money in AI as well. But right now, it's NVIDIA and Palantir, and then it's not even close in terms of monetizing AI and bringing in massive profits to that bottom line. And everybody is going to need their product into the future, which is why demand far outstrips supply, according to Alex and the team over there. So to me, it has a massive runway for growth overall. If we're talking valuation, we're talking something different here, but we're talking about the growth and the opportunity, and they have it in spades. So the next mark we talked about was consistent superior performance. And guess what, guys? I'm still waiting on a bad quarter from these guys. They have had consistent superior performance quarter in and quarter out and out for years, guys. 4 years. And the best anybody has given me in regards to a bear case or, well, that's not really true, Luke, they haven't really had good earnings here or there, is, well, Alex banged the table.
Okay, I think that's enough to give us what he's talking about. So he's betting on the management execution, on the AI growth. So the principle is the revenues from the AI will gonna start kicking in, and they're gonna be a product demand. So the company will gonna grow bigger and bigger and bigger, faster and faster and faster, and the stock price will gonna reflect that. But he also mentioned the valuation. So I'm curious why that is. I mean, I already know why it is, because it's probably overvalued as shit. But yeah. And then he's also betting on a consistent superior performance. Okay. Yeah. So Palantir. Okay. Let's find the stock. To see what we have. Oh, ticker symbol. I think it's PLTR, which is in the technology services. By the way, the data will gonna be in billions. So where you see 386.71, that means 386 billion and 710 million. And then if you see like a 0.85, that means basically 850 million. I had to normalize the data because I needed to calculate those ratios. So this is my input here, where I'm calculating the revenue in this instance as a percentage relative to the market cap. So if we look at the formulas behind this one, all it's doing is dividing the revenue by the market cap, and we get a percentage, which is basically 10%. This company at this point in time for this valuation is making, sorry, not 10%, 1%. It's making 1% of revenue, okay? And the same applies for the other metrics here. So we have the gross, which is 0.8%. We have the operating ratio, which is 0.2%. The net is sitting at 0.3% of market cap. Free cash flow at 0.5%. Wow. This is something that I wouldn't put my money on, because it's just simply way too expensive. And for us to understand that, I'm saying it's too expensive because when I'm looking at this ratio here, operating ratio to market capitalization, sitting at 0.2%. I did the S&P 500, and as a matter of fact, we're gonna do it now together to get a sense. Yeah. So if I remove the filter and we just look at the entire stock market, what I'm gonna do, I'm gonna remove the unprofitable companies, so below zero, because we want to get a sense of success. You know, those companies which actually will not gonna go bankrupt. So I'm gonna take out all the negative values. Okay, free cash flow, operating, and that's about it, because these are the two metrics that I normally check. It's quite enough to give you a sense of the health of the company and the valuation as a own. But to get that value that I was talking about, the market average, because I mentioned I checked S&P 500, and S&P 500 is sitting at about 5% in average for the average S&P 500 company. So when you add them up and then you get this average. So our Palantir is sitting at 0.2%, and then the S&P 500 is sitting at 5%. If you're asking me, that's a red flag. At some point in the future, not necessarily now, but at some point, the stock price will gonna go down like crazy, just because it's simply too overvalued. But let's move from the S&P 500 and look at all the companies that I have here. Okay, so we have 2,000 companies. Every single company that's above 1 billion in market cap. And our average is %11. That's crazy. Okay, so Palantir sitting at 0.2%. The average for the entire stock market, it's 11%. That would be 0.11 divided by 0.2%. That we're going to be 55 times more expensive than the average company. Okay, that's one off. The free cash flow, the second one which I want to see, is the average is sitting at 8%. Okay, again, if I remember well, Palantir was sitting at 0.5%. So if we get 8%, okay, divided by 0.5%, it's 16 times more expensive than the average. And to get a sense of that, I'm gonna do like a visual representation. Okay, so we're gonna pick up the operating ratio, then we're gonna do a quick scatter chart. Where is it? Insert chart. Okay, this is how it's looking like. I mean, we have those outliers. Let's take them out because it's just messing up our data. So 2015, 20 something. So we're gonna be everything that's above. That's, you know, like a reasonable ratio, which actually makes sense. Okay, I think that's. So these are all the companies, the entire market, right? 2,000 companies. Okay, 1,300 once we taken out the negative free cash flow, negative operating income. Looks like the the vast majority of them was not the vast majority of them, like 600 of them was actually not profitable. Okay, but I understand Palantir, it's an amazing company, and I understand we're gonna grow, but our average is 10%. So the average company, it's even lower because it's 10% because we have those outliers. We had that 50 something ratio and the one that I just removed, right? But we can see visually. So if we have a look, like we can visually draw an average like somewhere around this level here, which is again 8%, 7%. That's where it makes sense for a company to be from a valuation standpoint. Okay, it can get higher, it can get lower. The market is funny. People are, you have normally around the markets have this hype where most of the time people are not rational. They just see something going up and then keep pumping money into it, and then this drive the stock at record valuations and so on. But a sensitive investor would use this market average as a reference because this acts like a magnet. At some point, yes, a company will gonna go up and we're gonna go lower and we're gonna trade at a premium. And sometimes it's the other way around. The company will gonna go down and then they're gonna trade as a discount, which is basically this level between 10% and 20%. Operating ratio. But we as investors, we look into a future and we try to price that in, and yeah, basically the stock market is going to reflect the price of the future income, not the current income. And like I said, if we take the market average, which let's just say it's roughly about 7%, right? Our Palantir is trading at 35 times. So they need to increase their operating income by 35 times to get to the average company valuation, right? And they're currently making, let me filter it out again, Palantir. They're currently making 850 million trailing 12 months operating income. That means for them to get to its senses eventually, essentially, they need to make 0.85 multiplied by, how much did I say? 35, yeah, whatever. So they need, for this valuation, for this current valuation, 360 billion to make sense, they need to make 30 billion in operating income. That will gonna bring them to the average of the market, which is currently sitting at about 7%. Once we take out those outliers, we're gonna be roughly like maybe 7-8%. Okay. What are the chances for the company to make 30 billion in operating income? That would mean if they how much? I just want to calculate the ratio for the revenue. So if they need to make 3.9 billion in revenue for 850 billion in operating income, that's 3.9. So that means 21%. I'm just trying to calculate the market cap, okay? Sorry, not the market cap, the revenue. How much revenue they need to make, how much they need to grow the revenue for them to get to this sensitive level, which sits in the average market, because that's the sweet spot. Sooner or later, Every single company will gonna get to that point, whether you like it or not. It's not a matter of if, it's a matter of when. Okay, but essentially they're gonna have to do the same. They need to increase their revenue for 35 times. So if they make 3,900,000,000, if we multiply by 35, they're gonna add up to 136 billion in revenue. So that's the big question. How much does Palantir needs to grow on top of this 136 billion for us to value the company at these levels? Because if you want the stock to go up, you need to bet the fact that the company will gonna make more than this in the future. Okay, this is just the market average, but if you still want this growth and you say, okay, I'm gonna invest in Palantir because this company will gonna make that much and that much and that much and that much, it needs to be a lot more than that. I'm not sure what they do, but I just know 2%, 0.2% of operating ratio is just way too expensive for anyone that, I don't know, just trying to be conservative to some extent. So yeah, to close it up, I'm not gonna do SoFi anymore because we're probably gonna take too much time. So I'm just gonna stick with Palantir for now. And to go back to our video, this is a very, very bad investment. Please don't put your money into Palantir because they need to grow way too much for the valuation to make sense. And then you may get some gains if you get some gains, or you may get trapped and smashed because some of these investors which already made money on the company, we're gonna start taking out profits. So that's it for today. If you like this video, I'm just getting started, so I'm planning to do more of these videos. Hopefully the quality will gonna improve, and I'm gonna find better ways to present the videos and the data. But as for the first video, this is it. This is what I'm gonna do. I'm gonna be looking at these companies and I'm gonna calculate average market ratios and then try to figure out if a company it's sensitive to invest in. And please like and subscribe if you like it, if you want to support me. And I'm gonna continue I'm gonna continue to do this kind of content. Thank you very much, and I wish you a very nice evening. Bye bye.